Thank you very much for joining this evening in what I'm sure will be a very beneficial and insightful webinar. So as you probably realize, I'm not Robert Whelan, he's unavailable. So I'm Brian Forde, he's asked me to step in and introduce our guest speaker this evening. So obviously there's quite a lot going on in the world at the moment, but particularly the focus of this, there's a lot going on in investment markets. So we brought in an expert, Ian Slattery, in to give you an update as to what's gone on in the last year or so, and also the outlook for this upcoming year. So Ian, I'll pass over to you.
Great, thank you, Brian, and good evening, everybody. Look, hopefully you can see the slides there, which I'm showing, and as Brian mentioned, I'll try and bring you through a little bit about what's happened in 2025, a little bit of 2026 so far, even though we're only 6 to 7 weeks in, and indeed a little bit of a look ahead and some just general investment principles that I know we at Zurich and Brian and Bertie and the team at Rockwell also share. So without further ado, please do ask questions throughout as well via the questions tab, and we'll be happy to address them with Brian towards the end. So just to start at the start, maybe a little bit about what we do at Zurich as an active investment manager. For us, where we are in the economic cycle is really, really important. So if you think about booms and busts, recessions, and better times for economic growth, it kind of goes up and down. And sometimes you're down the bottom, you might be in a kind of a recessionary phase. And indeed, then the economic growth starts to recover and you have a better time for economic growth. So think about down the bottom, 08 to 2011 in the Irish case, and we're somewhere in the phase of positive growth. The reason I'm talking about that is that Zurich, where we are in that economic cycle, is really, really important, and that drives our asset allocation. So in terms of some of the points I'll discuss today, it's really important to consider where we are in that economic cycle. And that leads us to our top-down investment process. So as the name says, it starts at the top and works down. So for us, where we are in the economic cycle, as I just mentioned, is really, really important. And that leads us to asset allocation. So think about whether we want to be in things like equities or bonds or property or cash. Then you've got different parts of the world you can invest, different sectors down to individual companies and bonds that you might think. So at Zurich, we're very much active at each of those layers of that process. So just to start, as I mentioned, by looking back a little bit, so this is the story of stock markets or global equities in 2025, the calendar year. Many of us will remember the so-called Liberation Day. That was on the Wednesday, the 2nd of April, where President Trump was in the Rose Garden with the big piece of plastic, and he announced all the different tariffs that were going to be in place, and you can see how sharp that fall was that we saw afterwards. However, we saw a pretty nice recovery since then, and that nice 45-degree almost angle for the rest of the year. So trade tariff tensions were a large part of the narrative in 2025, but equally a large part of it was the concept of artificial intelligence, or AI, and that's what helped caused that rebound, I suppose, in terms of stocks, and that's some of the growth we saw. And AI is a big trend still in 2026, and I'm sure you're all listening and hearing about it day to day in the media as well. So I'll try and touch on some points in relation to that later on. I've already mentioned the global stock market, and I think it's just worth thinking about the different parts of the global stock market as well. So I have along the bottom different parts of the globe. I think it's always worth noting when we look at global stock markets, always remember that on any given day, 70 to 75% of all the equity value in the world is in the US. So when we talk about global equities, we're talking a large part about the US, and that really is the driver for what we might see elsewhere in the globe. But just sticking with that comparison of 2025, maybe to what we see now, what I'm showing you here is the bar chart performance for different parts of the global stock market in 2025. So you can see we had strong performers like Europe or the Eurozone, the UK, Hong Kong, Japan. The global market was up just over 5, nearly 6%. And then underneath, below average, was the likes of the US and Australia. The reason that's important is if we think about what's driven global stock markets over the last decade or so, it's been the US and US technology firms, the Magnificent Seven, this sort of narrative. So what was a little bit different in 2025 was we saw other areas of the globe, like the Eurozone and the UK, driving markets higher. So we just bring up alongside now in the darker bars is the performance of those same geographical regions, but in 2026 so far. So it's the 18th of February, so only since the 1st of January. But you can see in a slightly different way, but a similar narrative, right, to what we saw in 2025, also coming out in 2026. You see other parts of the globe, like Eurozone, UK, this time Australia, for example, all being in positive territory. And the only one, and it's the most important one, in negative territory in euro terms, and that's important as well. We'll talk about currency in a little bit. But the US has had a bit of a tough time as a global region in 2026. So it's just a little bit of a shift of the narrative. We've been talking about the strength of the US market and the strength of the the US economy, the strength of the US consumer quite a lot in the last decade. But we've seen a bit of a shift in that. Some of that's to do with the US administration and their policies, and some of that's to do with maybe a little bit of exuberance, if I could call it that, in the AI piece. So that's at a geography level what we've seen over the last 12, 14 months. Just sticking now to the global stock market at a sector level. Okay, so we're coming down another layer there, and this is the 11 main sectors of the global stock market. So you've got the likes of energy, financial services, or financials, tech in terms of IT. And this is the performance of all those sectors under the surface so far in 2026. So if you think about the big companies on the US stock market, these magnificent seven, you're thinking of Nvidia, Alphabet, the parent company of Google, you're thinking of Apple, Microsoft, okay? And they're all in the US, and the US has had a poor year. So think about the sectors of the stock market they might be in. They're going to be in those technology, communication services. And on the right-hand side, they're those companies that have had a bit of a poor 2026. So there's a correlation there, right? So to start the globe, the geography, the US has been poor, and the big sectors in the US are technology and things like that. They've been poor as well. So what you have at the other end is more what they call real world economy, if I could say it that way. So like energy, materials, consumer staples, industrials. Some of those more traditional companies have done well in 2026. And the big reason for that is AI, for artificial intelligence. So we saw a lot of good news about AI last year, and I'm sure everybody, as I've already said, was listening and hearing that and reading about it. But if you think about AI, the journey in the last couple of years, you might think of 2024 was this like ideation. So people started thinking about AI. I still remember the day ChatGPT came out, and it was like, what is this sort of stuff? And then we had in 2025 the idea of implementing AI. Okay, so now we have the tools, how the companies use them, how do we interact with AI as individuals. And now we're getting to the third space. So we've gone from ideation to implementation. Now we're thinking about monetization. Can companies actually make money off some of these ideas? And just what I'm showing you here is this interesting narrative that's come about. One of the big risks in markets over the last little while has been AI mightn't work. Okay, so it's all just a smoke and mirrors. It's not going to change the world. Part of the reason stock markets have been a little bit sticky in the last couple of weeks is people think AI might work. And the companies that might actually be impacted by AI are struggling a little bit. I'm just showing you on the left-hand side is, it's my favorite company name ever, if nothing else, but it is a tech firm that does karaoke machines, and they've called themselves Algorithm with a Y. So clever name, if nothing else. But this is a company that came out a week or two ago and said it's changed the way, nothing to do with karaoke, but they've changed the way companies will be able to route their orders and make efficient routes for their drivers to do deliveries and things like that. And companies like DHL, UPS, those traditional servers in that area of the economy, they fell as a result, whilst this penny stock or small stock algorithm went quite a bit higher. So that's just an example of where you're starting to see this difference in the stock market. The winners and the losers are starting to separate a little bit. And think about that in particular in this particular chart, for example. If I looked at the difference between the best performing sector of the stock market, which is energy. So if you look at energy year to date and what it's done, it's done very, very well, right? It's up nearly 16, 17%, whilst IT or tech is down 7 or 8%. So you're seeing a big spread, right? Almost a 20, 25% spread just in 6 weeks between the best part of the stock market and the worst part. And the reason is lots of little stories like this is coming about. Another big theme for the global stock market at the moment is this concept of hyperscalers. So again, look, a word that none of us had in our vocabulary until recently enough, and some of you are probably thinking it's still not in your vocabulary, but these are these big companies that are spending lots to invest in AI, in this kind of AI arms race. They don't want to be left behind with the concept of they're going to be trying to be the winners for AI. But however, and we have on the right-hand side those big four spenders around AI, and they're all negative year to date. So they're having a little bit of a tough time because the stock market's starting to think a little bit more, how well will these companies do? How sustainable is the debt that these companies are taking on? So just give me a little bit of a flavor in the stock market. Some of the things we're thinking about is the debt levels and the debt that these companies are issuing. That's on the right-hand side. And then on the left-hand side, the stock market starting to think a little bit more if we see some of this implementation and monetization of AI technology, who will be the winners and who will be the losers in particular sectors of the stock market. And just sticking with that theme in terms of saying it in a different way, these are three companies that have fallen quite a lot. So if you look at the left-hand side, that scale there, really, really big falls, almost 35, 40% for some of these companies in just 6 or 7 weeks. And these companies like Thomson Reuters, Salesforce, Adobe, they're more traditional companies that people are looking at saying, well, how will they do out of this AI implementation and monetization? So I've spoken a lot there, a lot about AI and the potential implementation of it. It's something that we're spending a lot of time thinking about at Zurich, and I'm happy to take kind of any questions on that as well. So equities are only one asset class. I spoke at the very outset about the concept of asset allocation and the importance of asset allocation and where you are in different parts of the investment universe. And another really, really important one is bonds. So when we think about bonds, we think about governments borrowing money from investors, and that's what a bond is. The way we look at it is you have a yield, so that's the return on the bond, and yields move inversely to price. So what I'm showing you here are two bond yield charts for Germany and for the US. And as that line moves down on the right-hand side, that means that bonds are winning, or they are seeing positive price returns. So that's been a bit of a good news story. So think about this kind of concept in a multi-asset investing. You've had a little bit of a sideways period for equities, but then you see these bond yields going lower, which means bond prices are going up. That's the concept of diversification. Okay, so for some people, of a particular age and a particular investment type, 100% equities is certainly the right place to be, but many people will find themselves in a multi-asset fund, and that's that concept of being across different asset classes and not having all your eggs in one basket. Another really important part of investing is currency movements. So we're obviously, as everyone will know, part of the Eurozone here in Ireland, but if you remember what I said a little while ago, the concept of 75% of all the stock market value in the world being in the US, which means it's also in the US dollar. So if you think about what we've seen so far, I was lucky enough to be in Boston for Christmas in 2024, and my euro bought me $1.03. If I was there today, it would buy me $1.18 or 19 cents. Okay, so really good news for anybody who's buying things in US dollars. Any of planning a trip away or anything like that, you'll get good value when you go to the US because your euro goes further. And that's what I'm showing you. As this line goes up, as it has in the last couple of weeks, that means your euro buys you more dollar. So that's us going that direction. But let's think for a second about all the money we have invested that's in the US. That's dollar buying euro back when we come back into our Irish pension or savings account. So that's bad news for us. So when we see this dollar weakening, it means our values go down and the currency is working against us. Sometimes this can work for you. Sometimes it can work against. It's something that's worked against us as Irish or Euro-based investors since the start of 2025. Just to note, though, when we think about the inception of the euro, so the euro has been around since 1999, The euro has been as strong as 160 to the US dollar. So it's at about 117, 118 today. And it's been as weak as 80 cents to the dollar. So a big range in that particular exchange rate. And interestingly enough, if we think about the long-term average of the exchange rate, it's about 117. So excuse the line's not exactly straight, but that's the long-term average since inception of the euro US dollar exchange rate. So I think it's just worth that little bit of long-term perspective. We've seen a lot of movements in the currency in the last kind of 12, 14 months. But it's, I suppose it's like anything, it's a long-term perspective is needed. Just thinking again about some other asset classes, gold is a really, really important one. So we invest in gold within our multi-asset funds at Zurich. And gold has had a very strong return. We see it at over $4,500 per troy ounce. So record highs for gold in the last couple of months. It's been very volatile recently. And one thing I point to, and we point to at Zurich, is what central banks are doing. So by explaining this chart for a moment, it's showing you every quarter going back 15 years in tons, how much global central banks are buying. So central banks like gold in their vaults. They can back different activities with it. It's very safe. Even if you're just eyeballing this, you can see roughly, again, excuse the artwork, but say that's maybe your average for the first 3 quarters of this particular chart. And when I get to Q1, Q2, 2022, let's say the average moves up a little bit. So what happened around that time? I think the most seminal event and the most material thing that happened was the Russian invasion of Ukraine. So since that date in February 2022, we're seeing a lot of central banks who may be considered non-Western increasing their gold buying. So why am I going through this? Why am I taking the time to labor the point? We're seeing a lot of central bank buying of gold, which means that gold has risen quite a lot. And as investors, we can capitalize on that as well. Now, it's been quite a volatile journey, particularly in the last couple of weeks. But as an active investment manager, we try and move in and out of gold at key times. So what does that all mean for us? What's our current positioning? What does it mean for you that might be invested or thinking about investing with us in some of our Prisma funds, for example? So when I look at our asset allocation and where we are positioned today as investors, I would say we are broadly neutral multi-asset funds towards equities. So each of our funds will have, say, an equity range. So if I took our biggest fund, Prisma 4, it can go as low as 30% in equities, as high as 60%. It's at about 45%. So think of that as the midpoint of the ranges. We spoke about different geographies around the world. So we would have a preference for Asian Pacific equities at this time. So that's taking money out of the US. So we will be slightly underweight the US. Now, it's really important to note that it's still the biggest stock market. And I've said it twice already, but for a third time, 70 to 75% of global equities are in the US. So even if we're a little bit underweight, it's still a big place to be. And it's very important. And at different sectors, we still have a bias towards growth in some ways, but we've pulled that back a little bit. And I won't go through the rest of it, but just to note that across our bond book and in currencies and things like that, we are very active and continue to make calls, and that information is available on our website on a weekly and a monthly basis. Just to talk about a little bit of performance before I move to some investment principles, and I appreciate there's lots of different colors lines on this particular graph, but this just shows one of our most popular range of funds, which is the Prisma funds. And it's designed to match your risk level. So for example, if you sit down with Brian or any of the team and you go through your risk profiler and you have a bit of a chat about what type of investor you might be, if you came out as, say, a medium risk investor, you might be invested in our Prisma 4 fund. Similarly, if you were very risk adverse and didn't want too much risk, you might be in Prisma 2. So a lower number signifies lower risk. And likewise, Prisma 5 or Prisma Max. I think, if I can say that, it tells a little bit of a story about what we might expect from a journey as an investor. So this is a line graph. So as it goes up, it's good news. As it goes down, it's bad news. So remember what I showed you earlier on around that April time when we had that Liberation Day announcements. if you're in a riskier fund, so think of Prisma Max or Prisma 5, the purple and the yellow, see how much they fell versus say a Prisma 2. So that Prisma 2 didn't fall too much because it's fairly low risk. So in this sort of period, low risk worked quite well for you, right? However, we want to take a little bit of a longer term view, and let's just see how much those other funds recovered. And now they're much ahead. They're far ahead. So just even from this January 25, you see a bigger drawdown for these funds, but a quicker recovery. So for me, this is a very good way to think about what the risk might be. Sure, your blue fund, your Prisma 2, didn't see a huge amount of falls, did exactly what it should do, it was quite steady, low volatility, but it doesn't see a lot of gains either. So that's the kind of risk reward trade-off that you have to think about as an investor, and you can kind of tease out when you're chatting to one of the team about. Overall, though, our funds have had very good performance. So just looking at from short term to longer term as we move from left to right. And again, I appreciate lots of numbers here. But for me, if you think about the very far right, the 10-year figure, we're showing you the Prisma 5 fund per annum on average versus its average peer group in the market. Same for Prisma 4 and the same for Prisma 3. So for example, if I took Prisma 4, our largest fund, the medium risk fund, 7.5% per annum every year for 10 years versus 6.2 for the average. So it's outperforming. It is giving you as an investor more than 1% extra over the last 10 years versus our peer group. And that compounds over time, and that's really, really powerful as investors. Just to move a little bit now, just before we maybe take a couple of questions and things like that, and just a couple of investment principles. And I know when I've spoken with Robert on previous calls, we've been keen to impress the importance of investment principles, and Zurich and Rockwell would share some of these principles over time. And this is what they call the patchwork quilt. I do like a complicated chart, so this is definitely one of those complicated ones. But what I'm showing you here is the concept of diversification at play. So 2015 through to 2024, and we're looking at each of the calendar years, how different asset classes performed. And each of the asset classes stays the same color. Okay, so commodities to commodities, commodities, so on and so forth. The point here is that overall, if you look at the portfolio, the fund, it's not the middle every year, but it's got a much smoother ride than say something like commodities that goes from top to bottom the whole time. So what I'm really trying to show you here is as a multi-asset investor, you're not always in a winner or all the winners, but you're never in the losers as well. And you have that kind of more smooth ride over time. Another really, really important point for us as investors is recognizing our own behavioral biases. So Brian has them, I have them, all of you have them on the call as well. It's hard to get rid of them, but I think once you recognize them, you can do something about them. And what I'm showing you here is making sure that we make the right decisions under times of stress. So when we saw Liberation Day and we saw very panicked headlines like we did in April last year, or indeed if we go back to COVID in 2020, it could be hard for us to make the right decision. And sometimes the right decision is to do nothing if you have a plan in place and just stick with it. So we have this idea of loss aversion. So what that means is losing €5 feels worse than finding €5, if you ever think about it. That's the kind of idea. We feel losses more than we feel gains. We have this idea of anchoring biases. So whatever we bought in on any given day, we think about that as an anchor and something we have to beat. We also have recency bias. So we think about the things that are news we've heard in the last day or two sticks more in our head than something we heard a year or two ago. I have a slide with at least 50 or 60 of these on them, and you'll be very pleased to know I don't have it with me today. But the idea is that we have lots of different biases here, and we just need to be thinking about them. And when we go to make a decision, usually a fund switch or stopping money going in or out, just making sure it's the right decision to make, or is it our biases controlling our decision making? And if we ever have any doubt, we pick up the phone or drop an email to our financial advisor. Because what I really believe is if we're all long-term investors, which many of us are, if you're 10, 15, 20 years or more to retirement, you will see a bad period between now and your retirement. I can almost guarantee it. Because what I'm showing you here is the history of the stock market going back 100 years in the US. And essentially the blue are what we call bull markets. So they're the good periods. And then the red is the bear markets. Okay, so if you look on the left-hand side, if anyone has studied economics or history, that's the Great Depression and the Wall Street crash in 1929 and the 1930s. We had the concept of the dot-com bubble, the financial crisis, COVID, just 1 month, and then we saw 2022 as well. But even if you just look at this, what do you take away visually from this is, well, a couple of things for me. The blue, which are the bull markets, they tend to be longer, and they tend to be steadier, and they tend to be higher. So that's what we might expect from the good times. What we see from the red, the bear markets, they tend to not happen quite as much, and they're shorter and they're sharper. So again, if we stick through the plan, we'll get to experience both these bull and bear markets, but those bull markets will lead us higher over time. So just to consider some of those principles of long-term investing, I think it's really important we stay disciplined. We sit down with somebody, we put in place a plan, and we stick with it. Of course, if your circumstances change, that plan can change, but not always. Cash is not the long-term answer. It's something I personally feel very strongly with. We have a huge amount of money on deposit as households in Ireland. It's earning next to nothing for the most part. And think about the impact of inflation. So we have cumulative inflation in Ireland of over 20% in the last 5 or 6 years. That means if you have 100 quid under the mattress, it's now worth 80. So just have a think about that reduction of your purchasing power if you're holding too much cash. Not all cash, you do need cash as part of a plan. And time in the market and volatility is part of investing. Think about that last slide I just showed you. The longer you stay in, the more likely you are to have a good experience, but you will experience ups and downs. But over the long term, we do believe that risk is rewarded, and diversification is very, very key as well. So that was just almost on time, which is unusual for me. Just a few bits and pieces, I suppose, to bring us through just the concepts of what we're seeing in stock markets at the moment. What we might see going forward is a little bit of a bumpy ride around this kind of people figuring out this artificial intelligence trade, or how that's working in the market at the moment. But if you stick with the plan, stick with your financial advisor, stick with your plan and financial broker, whatever it might be, you should be well served. So I'll stop sharing there for the moment, and I'm happy to have a bit of a chat, Brian, or if there's kind of any questions.
Yeah. So again, if I don't mind, I actually might ask a question straight away first and foremost. Very interesting. And thank you very, very much. So I suppose one of the kind of as I'm sure you get all the time as well, you can't help but hear about when you on the news and whatever, is when you meet clients, there'll be a lot of questions around the AI bubble that you hear about and the valuations being incredibly high, and people maybe likening it to the dot-com bubble back in the day. Now I'm sure you tell us that the valuations are wildly different and stuff, but I suppose, would you have any general comment on that, or what would you say to somebody who came to you with something like that?
Yeah, I think you can see the comparison makes sense at some points, right? There's a new technological advancement, things look very different, and it's going to change the world, right? It's dangerous sometimes to say this time is different. We should always be aware of that in markets. I suppose what we would say is a lot of the companies that did very, very well in 1999 were just websites, and people just thought pets.com and things like that were going to change the world because they had a website. What I will say about some of these big companies, think about Nvidia has been on the S&P since the early 2000s. Microsoft is over 50 years old. Can any of us go more than 5 minutes without using a Microsoft, an Apple, or a Google product? Okay, they are very much embedded in our lives, and they're very diverse businesses. So, for example, Amazon makes more money off its cloud services than it does in terms of its online shop. These sort of things. So there are easy analogies that you can make, and there are pockets of exuberance in the market. I think we're seeing that wash out a little bit. But these larger companies, as you said yourself, Brian, you kind of half answered the question, the valuations aren't where we saw them in 99, 2000, and that's important as well. And a final point on that is the valuations or the stock market growth from these big companies have been backed by earnings. I think that's really, really important. When you think of all the noise in the market, these companies are throwing off lots of profit. And equally, they are down year to date. So there's a little bit of a pause for breath that we're seeing at the moment. Yeah.
Perfect. Thank you very much. So that's actually probably a good segue into some of the questions in the chat. So if you're okay, I'll just read them out to you. So first question here saying, thanks, Ian. So Zurich Prisma 5, for example, is made up of 68% USA and just 10% Eurozone currently. Do you rebalance funds like Prisma 5 to be a lot more spread across regions, or is that ratio pretty much locked in, give or take a few percentage? How much scope do you have for rebalancing on our behalf in the likes of Prisma 5, especially in a time where the USA might be under pressure for a while? So kind of in line with what we were saying, with any kind of comment on that?
Yeah, it's a good question. So I suppose to answer it directly, we can do it every day. So we have the ability to change those geographical allocations on a daily basis as an active fund manager. We don't have to wait till an end of a month or an end of a quarter to do it. I think it's worth noting, though, if you take a lot of money out of the US, you also have to put it somewhere else. And I know that's a very obvious thing to say, but if we decided to go down to 50% in the US, do we like Europe enough to be 3 times its weight to go from 10 to 30? So we wouldn't tend to see a huge difference. So 68 versus 71, 72 is a material enough difference versus the stock market. I wouldn't see a scenario in the short term where that's massively underweight. But also think about what we can do within the US is we can move towards companies that are more exposed to different parts of the stock market as well. So more indigenous or domestic focused companies versus those overseas and vice versa. So we have the ability to do it every day, but we never do huge swings to like 80% down to 50% or things like that.
Okay, perfect. Thank you. So we'll stick on the US topic for the time being. Another question regarding the US was, do bond markets believe that USA national debt will remain under control?
It's another really good question. I'll try not to be too technical on this, but when you think about bonds, shorter bonds, so say a bond that's only is going to mature in 2-3 years, that's fairly influenced by interest rate policy. So what the Federal Reserve are doing, or the ECB. If you think about longer term bonds, like 30-year bonds, so countries borrowing for 30 years, that's much more influenced by the national debt. So think about it like, will the US go bust in 2 years? No. Might it go bust in 30? Probably not, but it's more of a risk. So that's why that focus at the longer end. The long and the short of it is the investors are getting a little bit worried about US debt. So it's now the biggest line item is interest payments. They spend more on servicing their debt than they do on defense now, for example. The debt is going to be above 35 trillion very soon with a T. Like, they're big numbers. So the sustainability at the longer end has meant it's got a little bit more expensive for the US government to borrow over the last year or two, particularly with the new administration. But anyone who remembers that yield chart I showed, the yields going down, that means that US borrowing costs are going down, which is a sign of confidence in the US market, albeit that's only a 6-week chart, I said. So it is definitely a narrative that the market has had it come in and out of focus. And debt in general. So if you think about the French government, Rachel Reeves had problems in the UK getting the budget over the line. Debt in the developed world is a general theme that as investors we're going to grapple with quite a lot in the years to come.
Okay, thank you. Another one here is kind of regarding the preference for the Asia Pacific equities. Firstly, is there any specific reason for that over other sectors, and are there other regions you might feel would be have on for a good year?
Yes, the two big points on the Asian Pacific piece is it's generally doing well in terms of that part of the global economy from a business activity perspective, and it should do well off some of the stimulus plans from Japan as well as one of the. It's not in that region from equity book perspective, but geographically very close. Secondly, emerging markets have tended in the last little while to do okay when we see the US dollar weakening. So there would be 2 reasons: just general localized economic strength, and then the movements in the US dollar. Other areas we've liked the Eurozone quite a lot at times last year, and the general consensus of this kind of relaxation of the German debt brake. So the German government going to spend more money and things like that. That should help the European Union. Or sorry, the Eurozone, and the concept of a little bit of less red tape, the regulatory burden in the US, making it more competitive. They had the Draghi report about this competitiveness piece. So in general, we are underweight the US, as I said. We put that money to work in Asia Pacific in the short term, but we may well look at the likes of Eurozone again this year.
And then I might kind of blend a couple of questions together because some of them are kind of slightly overlapping, but they kind of focus on some of the more alternative investments out there. So there was one question kind of querying the long-term potential and kind of immediate outlook for gold. And then another question asking whether REITs could be an investment option given their recent poor performance. So two different kind of assets there.
Yeah, I'll take the gold one first. It's interesting when gold went to $3,000 a troy ounce early in 2025. People said, "Oh, it can't go any higher." Then it hit 4,000, can't go higher, and then it went 4,500. Right. So, I think the big point for us is structurally there are people trying to move away from the US dollar, and that leads to gold as a store of value having a very strong place to play. That chart I showed you about the central banks as well, they're not very price sensitive. What I mean by that is central banks will go and buy gold when they feel they have to, whether it's 4,000 or 3,000 or 2,000. So that helps as well. As I said, we've pared back our gold exposure a little bit, materially actually in the last 2 months, because there's just a period of volatility. But we do think gold has a very strong place to play as a safe haven asset and as a diversifier in a portfolio. Was it REITs, the other one, Brian?
Yeah.
Yeah, so real estate investment trusts. So that's liquid or listed property companies. Global properties had a bit of a tough time in the last couple of years. It's just there's the narrative around work from home and that sort of thing. A lot of refurbs as well in terms of bringing commercial property up to standard, but it's having a little bit of a better time. I think it's worth noting though, when you invest in REITs, it is on the stock market, so it can act, they are equities even though they're property equities, so they tend to be quite correlated with global equities. But again, it's another lever to pull from a diversification perspective. And finally, on REITs, as we know with property, they're very heterogeneous. What I mean by that is they're very different. Each house is very different. Each property is very different on a commercial side. So I do think if people are looking at property investment, it's important to be in the detail.
And Ian, obviously a lot of the focus around the kind of commodities has been on gold. Would you have any comment on the other precious metals, for example, silver and copper and things of that nature?
Yeah, silver's been on a pretty wild ride as well. We do have some silver investment in the funds. Copper's done well as well as a more industrial metal. So when you think about clean energy, electronic vehicles, the amount of copper that's included in them, that sort of stuff. So we do think that copper is fairly highly correlated, not very highly correlated. It tells a little bit about the strength of the global economy. So copper has been good so far as well. Interesting enough, you didn't mention it there, but oil has been sideways to lower in the last 12, 15, 18 months. And you might think about some of the unfortunate conflict we've seen in the Middle East, particularly around Iran. You might have seen spikes in oil, but we haven't seen that materialize just yet. However, I think geopolitically, we're seeing oil play out quite a lot. We've seen the movement in Venezuela by the US administration, and it wasn't even implicit, it was explicitly a play on oil. And we're seeing some geopolitical tensions as well. So oil hasn't played out massively from a price perspective. We haven't seen it spike, but it has been a driver of geopolitical concerns.
An interesting question just came in now. So, hi, and you spoke about the impact of AI. Are Zurich currently using AI for predicting investment trends?
No, it's a short answer. I'm just about to start to use Copilot myself a day today. I'm very old school, but it's going to affect all our businesses. I'll tell you one anecdote is every quarter companies go out and they do their earnings. So your CFO and your CEO go out and they say, this is what we did last quarter, this is what we think. And then the investor community analyzes that earnings call and the annual reports and stuff like that. I was talking to someone the other day where they're seeing companies are now, before they do their speech, they're putting their speech through AI and telling the AI, please replace the words I've used with ones that sound better or more likely to get investors interested. So companies are using AI to make themselves more attractive. And then on the other hand, I was talking to an analyst who says he's using AI to scan and read the investor reports. So you have companies using AI to produce their investment reports, and then you're having investors using AI to scan the investor report, and there's supposed to be a human in there somewhere making an investment decision. So,
Yeah.
We use it a bit, right, in terms of collating information and not having to read things and summaries and all that sort of stuff. But there are plenty of people who use quantitative metrics, and AI might help with that. I would question at some point, is it just a load of AI bots talking to each other, and whether there's actually a human somewhere in the background making the investment decision. So it will creep into every business as we go, but there's probably an opportunity in it as well. As an active manager, if you think algorithms and AI technology is driving markets, that may well present opportunities elsewhere.
Of course, yeah, thank you, perfect. And then we'll do one last question. Now, I have my own kind of opinions in this one, but one person asked, how often or when should you review a private pension or investment plan?
Yeah, once a year is the general consensus on it, and I'll pass to you in a minute, Brian. But what I would say is, again, just going back to some of the investment principles, if markets do something very significant in a short period of time, I always ask people, well, markets might have changed a bit, but has your personal circumstances changed? And if you're still looking to retire in 20 years' time, and you're still looking to put in the same amount of money and things like that, whatever plan you discussed with your advisor 6 weeks ago is still the same plan and the right plan, no matter what's happened in that sort of period. So I'll see if you agree or not, but I'd say once a year, and then more frequent if you have a significant change of personal circumstances. But you're the expert.
Yeah. No, again, I agree. Yes, I think that once a year for most people is perfectly fine, because the fear is you can look at it too frequently, and then you can see your investment psychology creeping in, people making decisions that kind of negatively impact them long term. You know, if you're a bit closer to retirement, then maybe more than once a year in the last couple of years in the lead up to it. But for the most part,
Sure.
once a year is perfectly fine. So yeah, I think that kind of wraps up all the questions. Ian, thank you very much for your time, and your insights. It was very, very beneficial. I'm sure everyone found it. So look, from our side, thank you very much everybody for coming, and we'll send out the recording to anyone who is registered, so whether you were here or not. And yeah, thank you very much. And Ian, thanks very much again for a very informative presentation.
Great. Thanks for having me, Brian. Cheers.
Thanks, everyone.